Hey guys, Mike here. So obviously a rough week in the market last week and a lot of red days. Huge turn down on Friday after we were actually green going through lunch. And, you would have thought with the job report coming out, which was the big one, which is what the Fed's going to be watching for, all of a sudden the market reacted positively and then some more news came out, or maybe just because of the 3-day weekend, the market turned south and went red again. And so we're going to get into that, but we'll look at the chart and see where there's a chance we're heading or not heading, and where we're at in this cycle right now. But there's certain things you just gotta stay focused and keep in consideration. A lot of people are going to tell you out there, whether we're in a bull market, a bear market, just keep doing the same thing and just DCAing in blindly, and if that's your thing, do your thing. But I think if you've been one of those dip buyers since January, you're probably broke by now. Honestly, you just got to understand. This is a tightening cycle. We're in a different part of the economic cycle than we have been in recent years, and it's just something to keep in mind. But the good thing is, you're getting a chance, and we'll probably. And how many times have I said this throughout this 2022? And I said you were going to get multiple chances to buy your stocks on a discount, right? I remember seeing many YouTubers brag about these calls they had made and go, "Oh, I told you about this stock at this price," and they ran up in one of these, fake rallies, and then they ran back down, and those same YouTubers are very quiet about that. They're like, "Ooh, okay, yeah." Anyway, because now they're below what they actually told people to buy them at. And that's the kind of market we're in. Like, people are going to have to figure that out eventually. I don't know how many times, we're going to have to sit there and have a bear market rally here to figure that out. But who knows where the bottom's at? And the truth is, I don't even care where the bottom's at. I'm going to show you a chart where it could be at and what a lot of people are calling for, and I think why they're calling for that on a technical basis. But the truth is, like I did my DCA video, 3 weeks ago, whatever it is, I said, if you held out this whole time and just held your cash and you start DCAing in at that level, you're better off than all those people that started DCAing in January, right? Even if we continue to go down, you started a much better place to DCA down into, okay? And we could go down, who knows how much lower? I don't know, and can't predict it. Not even worried about it, to be honest with you. But, because guess what? In the long run, where does the stock market always go? Goes up, right? Maybe a rough couple of years. Who knows where we're going to be? But in the long run, it always goes up. So, when you saw the payroll come out the other day, what'd you see? Still a strong job market, right? 315,000 non-farm payrolls. Unemployment did rise to 3.7 from 3.5. You have to keep that in context. At 3.7 is still extremely low, and we'll get a little more detailed into that. Obviously the average hourly earnings getting to 0.3%, so still increasing a little lower than they estimated it at. And then the August average hourly went up as well. But if you look at this right here, I found this interesting that this is the percentage of people that are taking on 2 jobs now. And, you see the spike right there. So that's something that's going on, because a lot of companies are cutting back on hours, so they don't have to do the benefits to save money. And then, of course, what people figured out when this came out, this is what now they're expecting with the Fed funds rate, right? So 75 BPS in September, and then 50 BPS hike in November, and then 25 basis points hike in December. So that's what they're expecting. And so, of course, what does that set us up for? Obviously, they seem to be setting at 75. That's why they're selling the market off, trying to get there. So what do you think is going to happen if CPI comes out lower than expected and you see them do a 50 basis point hike, or even 75, but don't go over that? What usually happens every time, if it comes in under expectations and they've already sold the market off a lot, you can get to see another rally in the making. We'll have to see on that one. But that's really what it's setting up for. But does that mean we're setting up for a long term to move higher? Who knows? Again, there's people out there who keep saying that, and they keep being wrong over and over again, but they keep on saying it, right? I guess it makes them feel good. But understand, look at this chart here. I was going to show you this, that you see a lot of people coming out, and they're sitting there saying, hey, I think 3,400 is going to be the bottom, right, on the S&P. And the reason why I think it's more of a technical thing, you can see right here that trend line, which comes over and coincides with around 34 to 34.15 before we got on this $2 trillion stimulus, steroid market we were in right there. That's what I think. That's why some people are calling for that. And other people are calling for it to go lower just because, and this is probably where your Michael Burry type people are in, is because of this trend line that followed since 2009, right? This has been a very well-respected trend line on this bull market up, bounced off it many, many, many times. And that's around between 3,000 and 3,100. And so, it looks a long way down, but it's really not, because, if we measure currently after this sell-off, we're currently around 19.73, somewhere in there. So almost back to a bear market. and then that would be almost 30% down, 3,400, and around 36% down on the other line. I mean, I can see 3,400. Who knows? But that's like I said, 38 to 3,900 is what probably the majority think is going to be the actual bottom and stuff. And I don't know. I always go back to energy. You know, if energy stocks rolls over, what's going to happen, right? Because if energy stocks really, really, really roll over, I mean, really tank like they normally do, and they go on these big runs they've been on, you know, what does that mean for the economy? The reason why they're tanking is because obviously demand has just fell off a cliff, and so you know that's a whole different ballgame we'll have to see. But you know, nobody can predict that. There's just nobody knows that, right? And so we'll just have to see on that. But the thing to remember is, and I'm going to give you an update on this. I stay up with this because I have accounts with Fidelity, and that's just where we're at in the business cycle. I mean, that's just the way it is. And when you look, this is the updated one I gave you from a few weeks ago, where you can see, I mean, they have United States, Canada sitting there in late stage, basically, I guess they call it expansion, but now we're starting to go into contraction, right? And so, you know, that's where we're at on that. This is when, like, you know, growth moderating, credit tightens, earnings under pressure, all this sound familiar? You know, inventories grow, sales growth falls, all that stuff. And that's, I mean, that's where we're at right now, right? And then you got Europe, which obviously is definitely going to be heading into a recession eventually. I don't know how they avoid it. And China setting in more of the recession territory, which is, you know, falling activity, credit dries up, excuse me, and that kind of stuff. And so, you know, that's where they see us going. And if we click on the United States, you can see in Q2, they had us right there, right? We had the recovery. We're trending down right there in the expansion. Q3 right there is in late stage. And then we're going into contraction. So, you know, that's where we're at right there. And by the way, if you get anything out of this, please hit that like and subscribe button for me. I really appreciate it. And then if we go over here to more data, which is the manufacturing output by major economies, you know, on the left-hand side right there, that's contraction. And then on the right-hand side is expansion. And you can see, you don't have to be have a 20/20 vision to really make this out, but the majority of countries, the big ones, are setting in contraction, from US, Japan, Italy, France. And then you have Thailand, India, Colombia, Indonesia on the right-hand side. They're into expansion right now. And so overall, the world is into contraction. At least most of the major countries besides China has a little bit of expansion. So does Australia. And that leads us into this graph right here, which is the stock market and the economic cycle kind of overlapped. Because remember, the stock market always leads or tries to lead the economic cycle. And if you look at what's been hot right now, it's been utilities been killing it, and then healthcare has been very popular. It's getting bought up a lot by the hedge funds. That's what usually happens in this phase. That's the stock market right there, as you can see right there by the color. And then this is the economic cycle, as you can see the other color right there. And so obviously the stock market's been going down. Now you're seeing the economy start to roll over. And I think where this big arrow at is kind of where we're at in this phase right now, which is, you know, people are still trying to figure out, you know, early recession type deal or whatever. And the reason why it's so hard to pinpoint exactly where we're at in this cycle, and like it's been in other cycles, is just because the data is somewhat conflicting. Because obviously you have, yes, there's companies that are doing layoffs and non-hiring, and they're doing hiring freezes and all this other stuff, but the labor market is still so hot right now. And that's what's kind of confusing. It can turn very quickly, as we know. But right now, you know, it's still going strong. And then, of course, when you got real estate sitting there because of inflation being pushed up so high, everybody's still sitting on a ton of equity and stuff like that. And so you got that going on for them as well. And so the consumer is in much better shape. But I did show you what's happening. Certain, you know, income levels are working 2 jobs now, multiple jobs. And so how long will that last? You know, who knows? And so we're just going to have to kind of see. So it's just hard to kind of figure this out. If you saw what's going to go on the next cycle, you see real estate is where people start to buy. But right now, real estate is still high, even though it's coming down. And so, but a lot of people aren't buying real estate because they can't afford it, they can't get qualified. And the dangerous part is, what do you see banks starting to do now? Bank of America just rolled out something for minorities, saying you don't have to have any down payment. I don't think there's any minimum credit score or anything, which was some of the things you saw in 08, right? Because the banks are going to make money regardless. And what people worry about is the predatory lending. They're like, yeah, come on in here, don't worry about your credit score, don't worry about a down payment. So immediately when they buy the house, what's happening? They have no equity because there's no down payment there. If they have no minimum credit score, I'm not sure what the qualification is going to be. But if we're expecting the real estate market prices to come down and cool off, for those people buying now, they're basically going to be underwater right off the bat. I don't know what they're going to do with the interest rates on that, but I expect to see a whole lot of predatory lending happening soon from all of these banks. Usually one starts it and the rest of them just fall in line because they're going to make their money. Remember, they make their money off the fees and all this other stuff they charge you. So, we'll see how that goes. And of course, then that puts a lot of pressure on the real estate industry. If you start to see foreclosures go up because people who are getting the houses really shouldn't qualify for the houses, but they are because the banking sector decided to lower the standard way down. And so that's going to be a whole nother issue. But, getting back to the business cycle, that's where we're at, right? We're in this contraction phase. We're in a tightening phase. We're going to stay there for a while. We'll have to see. We're going to have these ups and downs. But to me, this is just a time where you look at it and say, hey, man, it gives me more time to accumulate my funds or hold on to cash, whatever you want to do, and just get the stocks that you like, do your research, and get them on a discounted rate. That's where it is, and so that's the way to look at it. We love to buy them when they're rocketing up, but we don't like to buy them when they're going down. So, and it don't mean they can't go down lower, because these stocks can go way lower. There's no ifs, ands, or buts about that. And we see how quickly the tide can turn, right? These stocks have fell off a cliff over the last week. And so some of them went up 100% and lost 50% already in 5 to 7 days. So, that's where we're at, though. And let me know what you think down in the comments, what you're doing. And I'll end up seeing you guys tomorrow. Yeah, absolutely. So have a good night.